You might have heard in the media lately that the US dollar is falling, and fast. That's true, and in fact it's falling at its fastest rate since 1973. Yes, in the past 6 months the US dollar has fallen by over 10% when compared with a basket of other currencies from the US's biggest trading partners. Some media outlets are even going so far as to say this could be the end of the dollar, and that the US dollar's era of dominance is coming to a close. I don't know if I quite know about that one. But what's causing this? How does it work? And why should we care? Well, before we dive in, I just quickly want to go over the basics. So what does it even mean when people say the US dollar is falling? Well, it means that generally speaking, if you're trying to convert your US dollars into another major currency, like the euro, you're going to get less than you might have done so a few months earlier. For example, if you were an American holidaying in France in 2023, you got €1 for every $1. Today, however, you only get 86 euro cents. This means the US dollar has weakened, and ultimately, les baguettes from le boulanger. I knew Year 7 French would come in handy one day. But here's the thing, the US dollar isn't just losing ground to the euro at the moment, it's losing ground to a lot of major currencies. The Canadian dollar, the Mexican peso, the Australian dollar, the British pound, the Swiss franc, the Chinese yuan, and even the Russian ruble. Actually, there's been a really big drop versus the ruble, with the dollar down 30% in the past 6 months or so. But why? Well, at the end of the day, currency strength is a supply-demand equation. If there are a lot of buyers for the US dollar, the currency strengthens, but if demand is weak or shifts to other major currencies, then the US dollar weakens. It all depends on how much people want or need the dollar. This is why the currencies of large, strong nations are usually more valuable and small countries less valuable. More people want US dollars than Zimbabwean dollars, and therefore the US dollar is more valuable. It didn't used to work like this though. For a long time, the US dollar was simply pegged to gold, and its value was tied directly to the amount of gold the US held in reserve. Now, this system, known as the gold standard, meant that the dollar's strength was relatively stable because each dollar was backed by a small amount of gold. However, in 1971, President Nixon ended the gold standard, and since then, the US dollar has become a fiat currency, meaning its value is no longer tied to a physical asset like gold, but is instead based on trust in the US government and its economy. And because the supply-demand equation for US dollars is now based purely on trust in the US government and its economy, it means that there are 4 key factors that can have a very large impact on the currency's strength. Number 1, inflation. Simply put, inflation is the rate at which the general level of prices for goods and services rises. As inflation increases, the purchasing power of money decreases, meaning that each dollar buys less. When inflation is high, the value of the dollar weakens because it doesn't stretch as far, reducing what consumers and businesses can buy. This causes foreign investors to look for better options elsewhere, as holding a currency that's losing value fast is not particularly attractive. So with less demand for the dollar, its value declines. That's number 1. Number 2, interest rates. To combat high inflation, a country's central bank may raise interest rates. Now, higher interest rates slows down the economy, which can help calm inflation, but they also strengthen the currency. Here's why. When interest rates rise, returns on things like savings accounts and government bonds become more attractive. For example, if you bought a US government bond for $1,000 at 2% a few years ago, you'd earn $20 per year. But today, with interest rates at 4.5%, you'd earn $45 a year. As a result, investors are more likely to buy these higher yielding assets, which means they need to purchase US dollars to make those investments. So this increased demand for dollars strengthens the currency. However, this effect does depend on interest rates in other countries too. For instance, if the US offers a bond at 4.5%, but the UK offers 5%, investors might choose to invest in the UK instead, strengthening the British pound. I should also mention that while rising interest rates strengthen a currency, if interest rates are lowered, the opposite is true. Returns on investments drop, and investors may look for better opportunities elsewhere, meaning lower demand for the underlying currency, which causes it to fall. Then from there, factor number 3, this is a big one, stability. This refers to both political stability and economic stability, which are key factors in attracting foreign investment. Countries with stable political systems, predictable business and tax laws, well-managed finances, they're all much more likely to attract foreign investors, whether it's a foreign country buying government bonds or a foreign business setting up operations in a new location. Investors obviously look for stable and trustworthy environments to put their money. If a country experiences corruption or political instability or frequent changes in laws, civil unrest, poor economic management, it makes the country a riskier place to invest. As a result, foreign investors are less likely to invest there, reducing demand for the country's currency, which weakens it. And then finally from there, the fourth factor is imports and exports. So when the US wants to export goods such as electronics, other countries need to buy US dollars in order to pay for those products. And similarly, if the US wants to import goods, say avocados from Mexico, it needs to exchange US dollars for Mexican pesos to complete the purchase. Now, in general, countries that export a lot tend to see their currency strengthen because foreign nations need to buy their currency to pay for the exported goods. Then on the other hand, countries that primarily import, typically smaller nations with less trade, they don't generate as much demand for their currency because there's no need for other countries to buy it. Now, you might be thinking, hold up, doesn't the US import more than it exports? And yeah, it does. But it's got a very powerful hack in this area where it still gets a major currency boost from trade. And that is because the US dollar is the world's reserve currency, meaning it's used in a wide range of international transactions, not even involving the US. A key factor here is that oil transactions are overwhelmingly conducted in US dollars, and this is known as the petrodollar. Because oil is traded in US dollars, countries need to hold US dollars to buy it, which creates constant demand for the dollar, helping to prop it up globally. So they're the four pillars that affect supply and demand of currency. But why has the US dollar been weakening so much over the last few months? Well, in this instance, most of the decline can be attributed to the third pillar, which is stability. And in this instance, it's mainly economic stability that has investors worried. There are a few things to talk about here. Number one is the deficit and the debt situation in the US. Now, I've spoken about this at length in prior videos, but because the US spends more than it earns, it fills the gap each year by selling government bonds. But the problem is that debt pile has now ballooned to $37 trillion. And when those chunks of debt get rolled over today, they're being rolled over at more punishing interest rates. The result is the interest cost on that debt is now in excess of $1 trillion per year. And the problem with that is that when the cost of debt servicing gets too high, you need to start cutting back in other areas to be able to fund it. Or if that's not possible, you have to add more debt to the pile to simply pay for the interest. Now, this is what some are starting to fear in the US, a debt spiral leading to a default, a situation where the US is simply unable to pay back the holders of its government bonds. And this is starting to be seriously considered by investors around the world. In 2023, Fitch downgraded the US government debt from AAA to AA+ due to deterioration in standards of governance over the last 20 years, including on fiscal and debt matters. Also, tax cuts and new spending initiatives, which have contributed to successive debt increases over the past decade, and forecast additional debt to GDP rises, increasing the vulnerability of the US fiscal position to future economic shocks. Earlier this year, Moody's lowered their rating too, citing similar issues. And with those risks still very much at play in 2025, investors aren't going all in on US government bonds like they used to. And this is seen particularly in the two largest foreign holders of US debt, China and Japan, who have drastically reduced their exposure to US treasuries over the past few years. Investors, on the whole, are shopping around and buying less US government bonds, which puts downward pressure on the dollar and upward momentum on other foreign currencies. Then on top of this, another factor in the stability column are the president's economic policies. As Al Jazeera notes, President Trump's stop-start tariff war and his attacks that have led to worries over the independence of the Federal Reserve have undermined the appeal of the dollar as a safe bet. Add to that the big beautiful bill, which is expected to add $3.3 trillion to the deficit by 2034, and you can see how investors are generally becoming more wary of putting money to work in America in 2025. But that's not the only thing weakening the dollar at the current time. Another thing to consider are those first two pillars, inflation and interest rates, which are working against the dollar at the current time. Inflation in the US has cooled over the past few years after it hit a peak of 9.1%. And while that's a good thing for a currency, as it gives foreign investors more confidence to invest without fearing massive erosion in their purchasing power, it also means the Federal Reserve is now looking to lower interest rates, which brings down the returns on US government bonds and makes them less attractive to buyers. Now, there's been a lot of noise lately about Trump going after Jerome Powell, claiming he's refusing to lower rates, but that's not really accurate. In fact, the Fed has already cut rates 3 times at the end of last year, and right now they're just holding steady. But the general direction we're likely heading is downward, which continues to weaken the dollar as investors look for better yields elsewhere. Then on top of that, there's also concurrent concern about inflation coming back up, especially if Donald Trump reintroduces or expands tariffs. Of course, tariffs raise the cost of imported goods, which can push prices up across the board. So even though inflation has cooled for now, investors are actually still quite nervous that a new round of tariffs could reignite price pressures, which would hurt the dollar's purchasing power and make US assets less attractive again. So interestingly, both interest rates and inflation fears are adding to the pressure on the dollar at the current time. So there's a bit going on, but is this the end of the dollar? Is it in terminal decline like the media outlets like to make out? Well, no, you could probably guess that, right? While the US dollar is certainly facing some headwinds right now, slowing growth, rising debt, shifting investor sentiment, it's still got one major superpower that makes it very hard to properly crumble. And that's the fact that it's the world's reserve currency, and that status doesn't disappear overnight. At the end of the day, the dollar is deeply embedded in global trade, finance, and commodities like oil. In fact, according to the Bank for International Settlements Triennial Central Bank Survey from April 2022, that's a bit of a mouthful, it says the US dollar was on one side of approximately 88% of all global foreign exchange trades, a share that has remained remarkably stable for decades. So yes, right now, it may be under pressure, but talk of its collapse is far more drama than reality. It's more of a recalibration than necessarily a complete downfall. But with that said, let me know what you think down in the comment section below. Also, a quick reminder at the end of the video, the live 3-day investing workshop that I'm hosting with Phil Town is fast approaching. This is a one-off event. Tickets are free, so if you're interested, get yourself to Atlanta this September. I've never done anything like this before, so honestly, I would love to see you guys there. It's going to be really, really cool. If you're interested in details, they can be found down in the description or in the pinned comment. But with that said, thanks very much for watching. Please like the video if you found it useful. And with that said, I will see you guys in the next one.